There is a provision inside the Internal Revenue Code that can legally eliminate every dollar of federal capital gains tax on the largest financial transaction most Americans will ever make in their lives. The provision applies specifically to the sale of your home. If you are a single filer, it can shield up to $250,000 in profit from taxation entirely. If you are married and filing jointly, that number goes up to $500,000. Those figures are not a special benefit for seniors. They apply to any qualifying homeowner. But seniors are the group most likely to have a home sale gain that approaches or exceeds those limits, because seniors are the group most likely to have owned their home for 20, 30, or 40 years. And here is the part that I need you to hear clearly, because this is the part your real estate agent will not bring up at the closing table, your mortgage lender will not mention, and your tax preparer may not flag unless they specifically know to look for it. Simply owning a home that qualifies does not automatically protect you. There is a specific form. There are specific conditions. There are specific traps that quietly disqualify seniors from an exclusion they believed they were entitled to, and they find out only after the closing has finalized and the tax bill has already arrived. By the time this video ends, you will know exactly how this protection works, who qualifies, what can disqualify you without warning, and the one step your closing agent is now legally required to take that makes handling this correctly on your tax return more important in 2026 than it has ever been before. Stay with me through the end. The stakes here are measured in tens of thousands of dollars, and in some cases, considerably more. My name is Sophia. I am an estate attorney, and for more than 15 years, I have sat across the table from seniors preparing to sell homes they have lived in for decades. The single most common pattern I observe is this: a seller who assumes their profit is protected, proceeds to closing, and then receives a tax document they were not prepared for, because one condition they were unaware of was not met, or because a step that needed to happen before closing was never taken. This channel exists so that outcome never happens to you. If you are new here, subscribe right now and turn on the notification bell. Every week, I cover the legal and financial rules that affect seniors directly, the ones the professionals in the room are not paid to explain to you. Now, let us get into exactly how this works. The law that protects homeowners from capital gains tax on a home sale is called Section 121 of the Internal Revenue Code. Here is what it says in plain English. If you sell your primary home, the place you actually lived in, you may be able to exclude up to $250,000 of your profit from federal income tax if you are a single filer. If you are married and filing jointly, that exclusion goes up to $500,000. This is not a one-time senior benefit. It is available to any qualifying homeowner of any age. But the people in this room most likely to have a gain that reaches $200,000, $300,000, or $400,000 are the people who bought their home in the 1980s or 1990s and watched it appreciate for 30 years. That is this audience. That is why this matters more to you than to almost anyone else watching YouTube right now. To qualify, you must meet two tests. Test 1, the ownership test. You must have owned the home for at least 2 of the 5 years ending on the date of sale. Test 2, the use test. You must have lived in that home as your primary residence for at least 2 of those same 5 years. Those 2 years do not have to be consecutive. You need a cumulative total of 24 months of ownership and 24 months of residency within that 5-year window. And you can use this exclusion once every 2 years. Now, here is why I said your real estate agent will never bring this up. The Section 121 exclusion does not appear anywhere on the closing paperwork your agent prepares. It is not a real estate document. It is a tax document. And unless you work with a tax professional who specifically knows to look for it and confirm that your situation qualifies, the protection exists on paper but may never be correctly applied to your return. There are 4 specific situations that quietly disqualify seniors from the full Section 121 exclusion ACE, and every one of them is more common among older homeowners than among any other age group. Trap 1. Rental or business use of any part of the home. If you ever rented a room, a basement unit, or any portion of your home, even for a short period within the past 5 years, The gain attributable to that non-qualifying period cannot be excluded. The IRS requires you to allocate your gain between qualifying and non-qualifying use. If you claimed a home office deduction on your federal return at any point while living in the home, the same issue applies. The depreciation you deducted over the years must be recaptured at the time of sale, and that recapture is taxable regardless of whether your overall gain falls within the exclusion limit. Trap 2, the 2-year lookback. You can only use the Section 121 exclusion once every 2 years. If you sold another home and claimed this exclusion within 2 years of your current sale date, you are disqualified from claiming it again. This affects seniors who downsize from a family home and then sell a vacation property or a second residence shortly after. Trap 3, the Form 1099-S reporting requirement and what it means in 2026. Starting in 2026, your closing agent is now legally required to report the sale of your home directly to the IRS using Form 1099-S, regardless of whether you owe any tax at all. This means the IRS will have a record of your home sale on file. If your tax return does not address the transaction, or if it addresses it incorrectly, the IRS will send a notice, months after closing, when the money has already been spent and documentation is harder to locate. If your entire gain falls within the exclusion and all conditions are met, your taxable gain is 0. But the transaction must still appear on the return. Silence after a 1099-S triggers an automatic IRS inquiry. Trap 4. The IRMAA consequence most seniors never anticipate. Even when your home sale gain is fully excluded from capital gains tax, the gross proceeds can affect your Medicare premium calculations. Medicare uses your income from 2 years prior to set your Part B premiums. A large home sale in 2026 can result in elevated IRMAA surcharges beginning in 2028, surcharges that can run hundreds of dollars per month, based on a one-time income event that no longer reflects your current financial situation. Form SSA 44, available at ssa.gov, allows you to report a one-time income event and request that Medicare recalculate your premiums based on your current reduced income. If you are selling your home this year, filing that form proactively could save you months of unnecessary surcharges starting in 2028. Here is exactly what I want you to do. Write this down or watch this section twice. Step 1. Verify your ownership and use dates before you list the home. Pull out the deed and your records of continuous residence. Calculate whether you meet both the 2-year ownership test and the 2-year use test within the 5-year period ending on your anticipated closing date. Do this calculation before you sign a listing agreement, not after. Step 2. Audit any rental or home office use in the past 5 years. If you ever rented any portion of your home or claimed a home office deduction on your federal return, you need a tax professional to calculate your gain allocation before closing. This is not a step to handle alone if rental or business use occurred. The depreciation recapture rules carry consequences, but a pre-sale calculation with a professional can often minimize or eliminate the impact through careful timing. Step 3. Confirm that your closing agent will file Form 1099-S and bring your improvement records to your preparer. Ask your real estate attorney or title company directly whether a 1099-S will be filed. In most 2026 transactions, the answer is yes. Bring your closing disclosure, your original purchase documents, and every record of capital improvements to your tax preparer. Every dollar you spent on a new roof, a kitchen renovation, a bathroom addition, or a structural improvement increases your adjusted basis, which reduces your taxable gain directly. A senior who spent $60,000 on home improvements over 30 years of ownership has a $60,000 lower gain than one who discarded those records. Do not discard them before closing. Step 4. If your sale produces a large gross income figure this year, file Form SSA 44 with Social Security before your Medicare premiums reset. The form is available at ssa.gov. It documents the one-time nature of the income event and requests that Medicare calculate your 2028 premiums based on your current income, not on the inflated year of the sale. Let me bring all of this back to the one point that matters most. Section 121 is one of the most generous tax protections in the entire Internal Revenue Code. For married couples who qualify fully, it eliminates federal capital gains tax on up to $500,000 of profit. For single filers, $250,000, and there is currently a bill before Congress that would expand that exclusion to $1 million specifically for homeowners over 65 who have owned their property for at least 25 years. If that bill passes, the financial stakes of understanding these rules correctly become even larger. But the protection is not automatic. The qualifying conditions are specific. The traps are real. And in 2026, the IRS will have a record of your sale whether you report it correctly or not. The seniors who walk away from a home sale with no federal tax bill are not the ones who trusted the process to protect them automatically. They are the ones who verified their qualifying dates, documented their improvements, handled the Form 1099-S correctly on their return, and knew about Form SSA-44 before their Medicare premiums were calculated. That is the difference between a protected sale and an unexpected tax bill on the largest transaction of your retirement. If this video was useful to you, do one thing before you close it. Share it with any senior you know who is considering selling their home this year, especially anyone who has rented a portion of their property or who claimed a home office deduction at any point in the last 5 years. Those individuals are the most exposed and the most likely to find out about these rules only after it is too late to act. Subscribe and turn on the notification bell. I will see you there.